we extended the coronavirus 6 weeks out in the United States, we were going to have a problem. I don't believe that the market's just going to go poof. If everything goes bankrupt, we're talking about almost every stock. So what you have is a disaster.
Welcome everybody to another edition of the Trader's Mind Chat Show. We talk to professional traders from around the world to get into their heads, their mindsets, to understand how they see the world, how they see the markets. And today we are very blessed to have Felix Frey of Options Geek here with us, a friend of the show. And the call that Felix made on this correction, well, it was absolutely incredible too. So on the 21st, I get an email from Felix that showed basically why he was starting to exit and get short on the 21st. I take a look at what's happening in my portfolio, and I'm seeing pretty much the same thing. I'm getting stopped out on a whole bunch of positions, and that Felix, to piggyback off of what he was saying, then I'm sent out an alert to everybody in the Trader's Mind Chat room and all my subscribers and everybody on the email list saying, hey, this is what's going on. I respect Felix a lot. Here's what he had to say. Here's what I'm seeing. It's time to take action. And yeah, we were able to get ahead of this thing, and thank God for that. So Felix, my friend, thank you for being on the show, and thank you for helping us out with everything that you do.
Hey, thanks a lot, Mike. I really appreciate having me on. I'm right in the middle of a move, so the place is a little bit empty behind me. I hope you don't mind that. I think I wanted to take today to sort of help people understand what's going on out there in the market as far as options are concerned, and how they can think about it. And how they could perhaps shift their focus a little bit from, from areas where they might normally look. I think because we're in a different time frame, we're in a different, just in a different environment, I think it's important to pay attention to certain things. So we can talk a little bit about that. At Options Geek, I founded Options Geek to really change the conversation. And the coronavirus plays right into that, okay? So the conversation has changed from traditional concepts like the Greeks and implied volatility, and changed and I'll show you today what I was thinking, how I was thinking, and how my thinking changed as the market was sort of moving and changing. How we picked a few stocks, and what I think going forward the market looks like, or what are the opportunities. So you mentioned it was the 21st. I believe it might have been the 22nd. Friday the 22nd is really when I saw what I saw essentially was a setup that I particularly like. That setup is a MACD diversion, and a MACD diversion is a MACD diversion is to me, it helps me spot the end of a trend. And usually what it takes is this trend like the SPY was having for several months. It takes a dip in price, which it did sort of in January, and then it takes a retest and even a push through the new highs, except the MACD is not going to show the same strength in the second move. The MACD comes off with the price from that first move, and then the second move where the stocks make new highs, the MACD is not making a new high. That's a MACD diversion. And for me, that has worked a good percentage of the time, and it's a good signal. And so after 3-4 months, I was looking at a signal from the SPY, but I was also trying to dig into the leaders, who was taking us up. Something that's incredible. I mean, as the market's going down, people think that's incredible. What's incredible to me was one of the largest stocks in the world, Apple, went from 170 almost to 340 a year, and it doubled almost without going down at all. And to me, that's incredible. Like that was incredible. And so I was waiting for this moment on that Friday. It just happened to be, it wasn't the first time I bought puts, and I don't want people to think that, I just all of a sudden said, this is the time. The way my mind works and what I teach the members at Options Geek is risk reward. And so I was already starting to turn the portfolio as early as late December. Now, that doesn't mean I go into puts, doesn't mean I stay in call. It just means that I start turning the portfolio a little bit more negative. So instead of mostly calls and some puts, I'm starting to turn the calls start turning into, like I had a gold call, GOLD was a call we had on. We had some other sort of defensive name calls, and then I was starting to try to add shorts. As you can imagine, nothing looked like a short as the market was going up in December and January. Just everybody was getting long calls, and the market was obeying sort of that right. But I started buying my first S&P put in December, actually, with the community, and I said, we're gonna need this. It might be wrong, it might be early, but at some point, we're going to need this, right? And so that's how we're balancing the portfolio, right? We're starting to change. One of the calls was GOLD. Another one of the calls was Gilead. So as the virus was starting in China, there were Gilead call buyers. It made sense that Gilead might be the answer, or the market might believe that's the answer. And so Gilead was a call. So you can imagine if we have 10 names, Gilead and GOLD gold are 2 of the 10 names as calls, which are really puts, right? They're supposed to go up when the market comes down. So that was two calls. And then we had the S&P puts, and we had a couple other puts. We had Weight Watchers puts and whatnot. So there were several of these puts that we were starting to load up position, and it started becoming before going into December, it was probably 6 or 7 calls for 3 to 4 puts. By December, we were already changing it to about 5 calls, 5 puts, and 2 of the calls happened to be would happen to work in reverse. So December, we were wrong. Those spies didn't work. The GILD calls were starting to work. Gold was starting to work. I bought more puts in January. Those, could have worked for some people. For some people, they might have been stopped out depending on their rules. And then I saw that we had been getting stopped out to some extent on some of these puts that we had. And so on that Friday, I realized Apple and Microsoft were very weak relative to the market. And those were the leaders. So combining Apple and Microsoft as weak stocks along with this MACD diversion that I was seeing, that was the sign for me that I needed those puts, and the risk reward was really in our favor here. Coronavirus I was reading a lot about it and was very nervous, and to me, I look at the world very simple, in a simple way. To me, it was a math problem. If we extended the coronavirus 6 weeks out in the United States, we were going to have a problem. I found it incredulous that we didn't have much, in the United States while everyone else had, because they let out 5 million people out of Wuhan, and those people went all over the world. So I wasn't convinced that the United States didn't have a problem. It was just a matter of time. So we got short there. On that Monday, what you may not know is that so Friday we bought puts. Monday the market was down, and we bought HYG puts as well, which is the high yield index. So
HYG?
HYG, that's the high yield index. So you can look at that on the Monday. Okay, wow. So we bought puts on Monday there. So I was frantically looking for things that could explode, and that didn't really on that Monday. And that Monday, the thing went down. HYG went down with the rest of the market. But, I knew that from past crashes that the way it usually works is, you have this problem, and then it starts working into the system, and the narrative becomes, well, some companies can go out of business. Like if there is a stoppage, exactly what's happening now. And that narrative, it's always the same. It starts first price action, and then that leads to, wait, what does that mean for the company? So I knew that first move in HYG was We jumped on it. We bought puts, and those worked out really well, really well. So that it was a progression of thought there.
So when you're buying these puts too, though, like one of the best questions that you answer for us is
How do you choose?
Yeah, how do you choose?
So I essentially teach the concept of mathematical edge infused into options. So what does that mean? Essentially, you have to believe that options are a probability game. Essentially, you have some strike and you have some optionality, you have some expiration, and that stock is either going to go up or down. There's some percentage up or down. It's about 50%. But then you got this element of strike, and the stock is going to go wherever it's going to go. But there's, we have to agree that there's some probability of the stock reaching whatever level. There's some probability. Okay, so when you're buying this option, you're really paying for that probability to happen, right? And if you think about options that way, essentially it's a probability game. You're playing a probability game, and it's a dynamic probability game. And so the only way to win at a probability game, the only way to have edge, is a concept called mathematical edge. And to really not dig into it, but really to give you an example, if I told you, Michael, I have a game, or I have, something that you can get 35 to 1 payout, would you do it? Some people might say, I don't know, what is it? Like, tell me more about what it is.
Yeah.
Like, yeah, but it's 35 to 1, who cares? And you say, well, what is it? And I say, well, I'm going to take you to Vegas, not today because you can't get flights. I'm going to take you to Atlantic City and drive there, even though they're probably not open either. But, I'll take you there and we'll go to the roulette table and I'll give you 35 to 1 odds. Just play. And you're going to say, nah, I know that the odds are not in my favor there, right? So in that game, 35 to 1, which sounds amazing, is no good, right? So now, using that same thinking, you go to the options market and you say, all right, I think I can buy this, and I think I can make maybe $2-3. And then my question is, how come when you went to go play roulette, you looked at 35 to 1 and you actually thought to yourself, I know that the odds are not in my favor. You may not know exactly why, but you know that 35 to 1 is not good enough. Yeah. How can you do that when you go to a casino with roulette? But when you're playing options, you don't look at the 2 to 1 or 3 to 1 that you think you're going to get, and you say, is that good enough?
Yeah.
And nobody does that, which is shocking, right? You just say, oh, I'm going to buy this option. I think I'm going to make, I'll spend $1. I'm going to make $2 or $3, and nobody asks the question, is it good enough? Right? And so I help people try to understand that it has to be good enough. And then I help people understand what it means to be good enough. So once I teach those concepts of mathematical edge infused in options and how to play the game with this mathematical edge, I built a tool to actually do all the analytics for you. So you don't have to think. What you do need to know is you need to say, I think that I like this stock, XYZ. I think it's going here in the next 4 weeks. And I have to have some level of confidence. So I built this tool, this sliding bar that allows you to play around with your confidence level. Now, people like to ask, what does that mean? That's sort of the one that people say, well, what exactly does that mean? And then I say, well, the best way to describe it is, let's go to Steve Cohen's portfolio, right? If you look at Steve Cohen's portfolio, he might have 100 names in his portfolio, 100 stocks, right?
Right.
The question you should be asking is, well, how many of them are options? And then you'll see that maybe he has like 10 or 15 trades, stocks that he also has options on. And then the further question is, well, why did he choose those 15 and not all 100? Right? Well, in those 15, he's either very confident on the direction he's putting that trade on, whether it's puts or calls, or he's very comfortable and very confident with the risk-reward profile. Okay? So what does that mean? Okay, now we go a little bit further. So let's think about what that means. And it goes to what's happening today. Okay, so now this is the way, by the way, when I tell you I'm infusing mathematical edge into the options chain and into options, I haven't mentioned the Greeks and I haven't mentioned implied volatility, and I won't. But this is the way that the top guys in the world think about options. This is the way their mind is working, right? If I spend $1 and I can make $3, $4, $5, is that good enough? Okay, do I have the odds in my favor? Now I'm going to tell you what exactly what that means. So here's a great video for you to watch, you and the people on the webinar. CNBC had Bill Ackman on the phone yesterday. He came on the phone just yesterday. And they said, Bill, what do you think about the scenario? And he was talking about what he thought. And he said how negative it could be, or things could go back to normal. Just that sentence should sort of lean to something is binary. There's a binary situation playing out in the market right now. He even said one of his stocks that he owns, Hilton and QSR, and basically all his stocks, he basically said either everything goes bankrupt, which it will, and I've been talking to the Options Geek members about that for 2 weeks. Either everything's going to go bankrupt or the government has to step in and do something, okay? And he even said about all the stocks that he owns. And he says, look, I'm actually buying Hilton today. I'm buying QSR because I don't believe that the market's just going to go poof. If everything goes bankrupt, we're talking about every stock, almost every stock. We're talking about all the airlines, all the casino names, Boeing, you name it, anything associated with consumers, restaurants. Every restaurant in New York City is on the brink of closing. So what you have is a disaster because it's not just corporations, all of a sudden everybody loses their job. And what the government has to prevent, because we still run a legal system, is the moment that someone declares bankruptcy, it becomes a legal event. So if Boeing is close to declaring bankruptcy, the government doesn't really necessarily want that because that's a legal event. You can't take it back. You can't say, oh, by the way, I was just kidding. Oh, you found the vaccine 2 weeks later. Just kidding. So there's a problem, right? Because that bankruptcy triggers bonds, a bond default. And when you get the bonds defaulting, that's a big deal. That has ramifications now for corporate bonds, okay, where spreads widen out. It has ramifications for everything down the line, okay? That's step two. The last step that you'll start hearing, I presume, in the next week or so, is that the pension funds are underfunded. What does that mean? Well, it means that every fireman, every nurse, every police officer, part of their pay goes into this fund, and that fund has to make a certain return. Well, corporations have these funds as well, these pensions that, IBM, they have these pensions. They guarantee 7.5% a year forever. How do they make that? Well, they got to invest in stocks. Because surely bonds are, corporate bonds are yielding 2%, 3% is nothing. So they got to make this 7%, they got to be in stocks. Well, when they're in stocks and you have a year like last year, that's great. When you take it all back and then some this year, well, then you got the pension funds who are not hitting their marks, who now have a liability on their balance sheet each quarter, each year that they owe. It's like a loan. They owe their pension X dollars. So if the pension funds blow up, the government's going to have to save the pension funds because that is all of America, right? That's the people of America. Right. And that's trillions of dollars. And so these defaults, it's basically the Lehman Brothers moment from 2008, 2009, where you have Lehman Brothers possibly defaulting, causing the banks to just collapse. And the banks are the center of the economy. And if the banks collapse, everything else collapses. So, so in a way, this isn't an option, meaning the market can't completely shut down forever, right? Otherwise, our financial world is completely in dire straits. So given all that, it's very interesting to hear someone like Bill Ackman come out and say, we're in this binary scenario. Either they find a vaccine and we kind of go back to some normality, whatever that might be, or we're going bankrupt. Now, how is the options market pricing in all that? I can tell you it's not really caring about volatility right now. You can look at it yourself. You can look at all the different names, and volatility is 150, 200, 250, 300, downside puts of 400. All the available education has basically said, oh, you should be selling high volatility. It's pretty dangerous right now to sell high volatility because it's a binary situation, okay? Now, more specific, let's just look at the pricing of some of these names. If you look at MGM.
All right. Yeah, hold on a second. Let me bring it up.
Look at the options pricing for old MGM.
All right. Hold on one second. All right. So MGM.
So the stock's gone from $35 to $8. Right?
Yeah.
Okay. Do you have the options prices there?
Actually, can we bring up options, Geek?
You know what? I don't have my thing set up right now just because it's all. I'm afraid that the internet's gonna go down here. You can bring it up on yours. Yeah, bring it up on yours.
All right. Yeah. Hold on a second.
I'm just afraid of the bandwidth here.
Do you see it?
Yeah. All right. So click on MGM.
All right. MGM.
Go. Let's go to January.
All right. So
January options, right on the above, yeah, right there. January 21. Yeah. All right. So everything else is so high and vol that it's basically no good. So what this is saying, just look at where the 5 strikes are in January. This is just an easy one. The 5 strikes. The puts. 275, right? 195, 275. So you would have to pay about $275 to buy the $5 puts out to January. So the most you can make, the most that would be worth is $5, right?
Right.
So you would pay $275 to make $225.
Yeah, that doesn't make sense.
Well, maybe it does, right? If you know that MGM is going, what is that saying to you? That's essentially saying to you that, let's say it's too easy math, 2.5. 2.5 to make 2.5. That's an even bet. What it's basically saying that the market is pricing in a 50% chance that MGM goes bankrupt by the end of the year. Now, it's your turn. Do you want to sell it or buy it? Okay, so now you have to know, okay, well, do I think MGM is going bankrupt? And what percentage probability is that, right? You can also start looking at the bonds. So what's going on, like stick on WIN, W-Y-N-N. Again, let's go to January. All right, so January, let's take a look. The 20 puts are 550. Let's just say it was $5. Let's just say it was $5. $5 to make 15. So the market's giving you 3 to 1 there. 3 to 1 maximum. That's the most you can make, 3 to 1, which is basically saying that there's a chance WIN can go bankrupt. Right? And you can do this for all these types of names. I did it yesterday as an exercise. You can go through even further strikes. Well, my thing, it's after hours here. So what do we got? Did you just go out?
What was that?
Yeah. So you can look at any one of these and just do this similar exercise on downside puts, and you can get a sense for what the market is pricing in as a percentage probability of bankruptcy.
What if we look at something like Apple?
Let's look at Apple. Now scroll up. Can you go up a little bit? Or go down. Sorry, go down. See if there's anything. All right, so it stops at the 140. So the 140 level is $10. So basically, you see how different that is. Now it's 140 down, so you have 128, call it 130. So 10 to make 130, 13 to 1, right? 13 to 1 on your money. That is what, 7.5%? It's not much, right? 7.5%. Okay, so it's saying, okay, Apple has so much in cash, it's not going bankrupt. So,
interesting.
You know, so these will be higher. But you can go through the industries and you can start seeing. It's better if, I don't have, because I don't tell people to play around with those strikes. It's more interesting if you go down to like the 5 strike puts or the 10 strike puts, because if something goes to bankruptcy, it goes to 0.
Right.
So In general, that's one way. Now, you can go to the upside. Let's look at the January 300 calls. Where are they?
January 300.
$20.
Yeah.
Okay, so January 300. Where's the risk reward break even number on the left? 385. See the yellow column? 365. Yep. What does that say?
385.
385. Right. It's basically saying the market's basically saying if you want to buy the 300 calls in January, then in order to get the right price, in order to get the right odds in your favor, that your thinking has to be, we're going to be above 385. Okay? Then it would say, you know what? The odds are in my favor here. Otherwise, you know, if you think it's going to go to 350, you're going to pay, what is it? $20 to make $25? 20 bucks to make $30? One to make $1.5? That's not a good bet. Not with the stock trading 245. So you see that sort of mentality of how they're looking at the world and saying, okay, well, if it goes from here to here, this is what I think. Now, people are going to say, well, there's time value in the option. And you're right, there is. And so if the stock does go to 350, where do you think the 200 puts are going to be worth? And say it's going to take 3-4 months to get there. So you'll have 3-4 months left of this downside 300 part. How much is that going to be worth? Maybe it'll be worth $7, $6. Maybe, you know, with 3 months to go, the 300 put, maybe it'll be worth $3. So the call option is going to be parity plus that 300 put. So essentially, okay, it's going to go from 20 to, say this Apple goes to 350. That'll be 50 in parity plus $6 on the put plus a little bit for interest, which is not much now because interest rates are 0. So you got yourself $56 on the call. You paid 20. You don't want to do that trade. It's not necessarily a great trade. If you really thought it was going to go that high, you probably want to buy. You can buy in that case a call spread, maybe a call spread. Or you buy something that'll give you better odds.
Interesting. Yeah, I just put that 350 target in here, and it. Whoa.
It pops up right there. You all right?
Yeah, that got some feedback, it sounds like.
So it pops up there, but now move the confidence bar a little bit. You see how it's, the more confident you are, the more it's going to push it out. Okay? The less confident you are, the more it's going to push it closer to where the stock is.
So if you think that the price is going to go to 350 by January, then you should buy the 240 strike.
If your confidence is not that, if you're not that confident,
yeah, like if it's a 50-50.
Yeah, relative to stock. Yeah, it's relative to stock. So now, no, not 50-50. If in your mind, this is the 5th best trade. If you were 100% sure, let's put 100% in there. Okay, now click on, you see where it says calls? There's a blue dot. You see the H on the right-hand column?
See the H?
Yeah, you see H? Go to the right-hand column.
Yeah, right here.
155% right there, right?
Yep.
That is the highest percentage return of any option on the board if the stock goes to 350 on expiration in January. So what it does is it says, look, if you're absolutely certain, and you should never be certain, but if you're absolutely certain, then there is no probability analysis, right? There's no probability analysis. You just want the best return on your money. Now, if you start moving the confidence bar all the way down to 0, and you just made it this sort of like binary event, then essentially you're saying, we're just going to go by the probabilities given by Black-Scholes, and that is your best option, the 215. Because that's just focusing on probability. But as the more and more confident you get, and when Steve Cohen does a trade, he's very confident in the trades he's doing with options. So it's gonna move down. I defaulted to about 80%. But what I'm telling you is that this is a trade that you feel confident that your target stock price is good. You like it. Now, the next question is, how do you get the target stock price?
Yeah.
Well, that comes with fundamental analysis, data mining, that comes with technicals. You know, in the short-term options work great with technicals. You break out, you sort of know, you got this band, and then you go higher. You know, you can sort of pick your level with technicals. You know, with fundamentals in this environment, fundamentals may not necessarily matter in the next while.
And when you say short-term, well, what's short-term in your mind?
I would say, you know, technical analysis anywhere from, you know, 1 week to you know, 2 months.
Okay.
You know, when something breaks out, you know, swing trading, you're finding that, you know, it's in a band for 8 months, $10 wide, and then it breaks out. The general rule is that if it actually breaks out and is a breakout, it should go up at least $10. You know, so 10 on, you know, the band was 10, it breaks out, it goes up another 10 before maybe it comes back on a retest in there. So you could say, okay, in a breakout, I get a $10 of room here. That's a target.
Yeah, interesting.
So now you could use, what I do is I tell people, focus on what you know. Don't worry about the options analysis. The tool will take care of it. Okay, the tool will see, you know, you find that level, you say, all right, here's a stock, I anticipate a breakout, and when it breaks out, it's gonna really zoom to this level. You know, I heard, you know, I was reading your stuff on Tesla, and you were talking about this thing's on fire. It's starting to really curve up. It's starting to really make that move, and it can make a really outsized move, right? And your thought was, you know, it's got a lot of momentum, and it's reaching you high, and this thing could explode, and it did. And it went up a hell of a lot higher than anybody ever thought. And options were the right play there. And I saw that you were playing and looking at them, you know, because if you thought, most people wouldn't have thought that Tesla could have gone above 600, you know, 700, 650. But if you were paying attention and you look at the chart and you see the band, it literally went from 500 to 250 or 200, wherever it went. That's a 300-point band. Look at Tesla's chart.
Yeah, let's pop it up. Yeah, from December.
Yeah, no, go back a year. I can't go back 2 years, just to give you a second. Go back 2 years first.
All right. Yeah, well, let's look at the weekly chart. All right, so right here, this is February 2018.
That's 2018. What's that low all the way on the left? What's that low? All the way on the left. What's that
Over here?
low? Yeah.
The 140.
What's the low all the way on the right?
176.
Okay, so 140, 176 on the low. What's the highs up here? And all this section in the middle. What's the highs?
Highs were about 380.
All right, so 380 to 140 is 240 points. And then 240, 380 and 170 is about 210. So somewhere around 225 points. You can see there's a band there. It's up and down twice. And in the middle, it's got a couple of up and downs as well. So in my mind, I would simply say, I would just add 225 to 380. And I would say this has, if it breaks 380, it has the possibility to go straight to 600, And if it gets to 600, which it did, it has that wacky possibility to kill the shorts one last time and go up that extra amount, which who knows how much it can go.
Interesting. So, why that amount?
Why what? Why?
So how did you get your 600 target?
I just simply added, I took that long band, which is a long-term band of about 225 points.
And just added it to the next level? All right.
I said took the middle, 225 plus 225 plus 380 is how much? 605.
Yeah. So like as a one-to-one trade, yeah, it lands you around 620.
Right. So that's all I was saying. I was thinking to myself, if Tesla breaks 380 on decent volume, okay, and it hangs in there for a little bit, it could easily go to 600 because everybody in this band, remember it's a psychology, technical analysis just measuring psychology. There's been a lot of trading in this band over a couple of years. Mm-hmm. When it gets above that, those are new buyers. And at that point, all the shorts have to be worried that the new buyers are in, and they start covering, and it causes this spin. Now look at where it went. It literally wiped out the shorts, and then it dropped immediately back, and look where it's at. It's back this range. So that,
Yeah.
to me, that could actually go back down to 100 now if things get bad. Before, there was too many shorts to push it to 100. Now the shorts have been wiped out. There's only a few left. Now it could actually go down.
Yeah, that's interesting.
Look at, how about this? Look at, let's just see. Look at Apple. Go to Apple for a moment. Go to Apple 5 years.
So 5 years ago. So that's yeah, around September. Yeah, right around here. Yeah, February 2015.
Okay, so I usually, by the way, I try not to go too many on the channels. I'll use them a little bit if I see a clear one. What I try to do is I try to go horizontal. So on the left, you see the highs. What are the highs over there?
Right around 135.
135. How about from 135 to the highs, to the next high up in 3/4 of the way? Right there. What's that?
Right over here?
Yeah, what's that?
That is about 235.
So what is it? 125?
135 and 235. Nice simple math.
How much is that?
Oh, $100 between the two.
Oh, good. Now let's add 100 to 235. Tell me what you get.
You get 335.
335. What was the high in Apple?
High in Apple was 327.
Close enough.
Yeah.
Now look what it did. It came all the way back, and it traded right near where it broke out. You see on that breakout, when you first broke out there at 235 back in October, that's a big breakout.
Yep.
And so all I did was take that range and saying, like, this could be, I didn't believe it. It's not that I'm saying I believe it. I'm saying that this could go, can this really go to 335? Like, it could. Can it really go to 335? My goodness. That would be insane. And it did. It close enough, right?
Yeah.
Then I'm thinking, okay, now it got there. Guess what? It usually comes back to that breakout point. Can it really come back to 235? Can it really do that? Well, here we are.
Yeah.
So, at the end of the day, if you kind of like start looking at it in a simple way, and by the way, you can do this with Apple. You can go back 20 years and you can start seeing very similar things.
Yeah, here's a monthly chart.
CMT, but I've looked at a million charts in my life, and you can see the steps and just go one by one how they went up. Here, take the top. What's that? 20. What is that?
What, back over here?
Yeah, what is that?
Yeah, that's 30 bucks.
What's the next high?
Yeah, the next one where we drew the line, 130.
Yeah, no, the next one
over here.
Keep going in the middle. Before the other one at 135.
Right over here?
No, a little bit higher. Keep going. The big one there. What is that?
This.
Yeah, what is that?
That's 100.
100, okay? I'm gonna show you another one, okay? So what's another thing that I'll look at too to kind of break my range? Give me the low over here. It went to 20, whatever that was. Give me the low in the middle of the, when is that? 2008. Give me the low in 2008, 2009.
Low 2008, 2009.
Right there. Yeah. What is that?
11 bucks.
11.
Yeah, 10. Yeah, about 10 bucks.
All right. So 11 to, what's that line? What's that high there? 100? 11 to 100 is how much? About 90?
Yeah.
What's the low in the middle of 2013? 2013, what's that low?
That low is about 50.
50. So what's 90 plus 50?
140.
Where was the next high? We just said 135.86.
Yeah.
130. Okay? We're close. I'm not saying it's good bulletproof, but I'm saying we're close. We kind of got this range. And you can do that all the way up the ladder. It's sort of a A, B, C, D. It's, I forgot the actual name. I just know it as A, B, C, D. But these are simple technical stuff. You don't have to be Mr. Guru. Simple horizontal lines, bigger, wider, just to see it and sort of figure out and say, wow, can it really go there? It could. because it's basically pressure. You know, it's what technical analysis essentially is showing you psychology and pressure in the market, volume pressure and whatnot. So it's a lot of psychology, and it just happens that, and that's why Fibonacci, you know, they use Fibonacci here. These are mathematical, you know, mathematical things that happen in the world, and part of the world is how we think and our brains and all that stuff. So that's where all this stuff comes from, but it's a psychology test.
Yeah, do you use Fibonacci?
Every once in a while. I look at everything every once in a while. I'll look at everything to kind of like say, you know what, this is interesting, or, you know, simple stuff though. That's probably as far as I go. MACD is as far as I go. MACD, for my MACD diversion, as far as I go. But yeah, so I think, you know, I just think it's important to look how simple it could actually be, right? Because most people are not going to be analyzing options, right? The Greeks and implied volatility, they don't need to get that deep. Let me give you another good point. All right. Here's why the top guys in the world trade this way. Here's why. One, in any probability game, what's the main goal? You want to reduce your guesses. You want to reduce your guesses. You don't want to be guessing at 20. If you can reduce the guesses to 2 guesses, or 3 guesses, or 1 guess, that's all you want to do.
Right.
Right? 2, we got to know our target stop price, right? And 3, expiration, target stop price, and then you can start adding everything else. And what the available options education is, this introduces all these concepts of the Greeks and implied volatility. And if you got to guess, if you all of a sudden say, okay, I want to know where implied volatility is going to be, that's just another guess. Okay, you can look at a million charts. It's really a guess, and you want to reduce that. So how does the top guys in the world, how do they reduce this guessing? Well, one, they pick a date that has some event. All right, an event is going to move the stock, and then they have the analysis of where they think that stock's going to go. So are they guessing on a date, just randomly picking on a date? No, they're picking a date that includes their event. So that reduces that guess. So the probability there is gone, right? Let me take a step back. If we had to pick 3 times, if we had to make 3 guesses, and on each guess, it's 1/2, 1/2, or 1/2. We have to flip a coin 3 times. What's the probability of guessing it 3 times in a row, getting it right 3 times in a row?
Yeah, very small.
1/2 times 1/2 times 1/2.
Yeah.
Which is 1/8, which is only 12.5%. So it's not very high. But if you just reduce it by that 1/2, now you're at 25%. If you get that even lower, you can get it below 1/2. So the point is that if you do it with 1/3, you can see 1/3, 1/3, 1/3. You get to 127, it's like 3%. So the more guesses you have, clearly the worse you're off, the worse you're going to be. So they reduce the guessing of the expiration date. That's out of question. They focus on the target stock price. Where do you think it's going? Okay? They know the date, they focus on where it's going, and then what they do is they focus on what they know. In options, this is important. I'm going to ask you, what do you know for sure? No guessing. The only thing you know for sure, okay, in options is how much the options cost today, right now. Okay? How much it costs. It's right on the screen. You can see all the options right on the screen. How much it costs, 1. And the second thing that you're sure of is how much it will be worth at the minimum if the target stock price is reached by expiration. It's going to be worth parity. Okay? Like we did in Apple, if the stock goes from 244 to 350, we know the 300 calls are going to be worth at least $50.
Yeah.
That's the only thing we can be 100% sure of. Okay? And so that's what they focus on. You see how they reduce the guessing? Guessing reduces the chance of winning. They don't guess on expiration date. They're looking for an event to play options. They are not guessing on implied volatility. Okay? They are buying an option which they know how much it's worth today. They have to buy it. And they know how much it's going to be worth if their target stock price is hit. target stock price is hit. Now, what are they guessing on? They're guessing on their target stock price. And that's where they're focusing all their energy and all their manpower and money is going towards where is the stock price going. Okay?
All right.
That's why the Greeks and implied volatility don't necessarily matter in their thinking.
Wow.
Does that make sense?
Yeah, I think so.
That, for the first time, listen, first time, I do this with slides. I do this in all the education is based on risk reward. All the education is based on this type of thinking. Getting away from the Greeks, the gamma, the vega, the theta. And I explain why. And look, I explain the Greeks if you want to learn that stuff. And I think I give a great explanation. And it's there if you want to learn it, because look, the top guys in the world, they're not day trading options. If you're day trading options, then you got to know what delta is, because that's really the bet you're making. You're buying a 60 delta in the money option. You're sort of basically buying leverage. Okay, but they don't trade that way. What they do is they trade exactly what I told you. We're going to hit my target stock price within a certain date. I think I'm going to pay this. I think I'm going to make that. Is that a good bet? The computer, the tool that I just showed you that we just worked on, that is telling you whether or not it's a good bet or not. It's thinking exactly the way the top guys in the world are thinking.
Yeah, it's such a great tool, and I love that you could, it doesn't matter, what style you're trading. Like, you just come up with your target, right? I'm not following Steve Cohen or Carl Icahn or those guys. I'm following Bill O'Neill. I'm following
That's
Martin,
right. That's right.
Those guys.
That's
and
right.
It still works well with that too.
That's right, because the tool, the new options chain, which is basically an options chain that's interactive, but the new options chain essentially is just taking out the options analysis. You still have to do the other part, the process. Okay, so you have a process, the next guy has a process, I have a process, everyone has their own process. Ultimately, you need to come up with what I've asked of you, and then you can just stick it in the options tool, which is what you're supposed to do anyway, and then the tool is going to tell you, hey, look, this isn't a great buy. But now what you could do is you could say, okay, well, that one's not a great buy, but that one might be a great sale. So maybe I'm comfortable doing a buy right or selling options. So that's what it is. It goes in reverse as well. If it's not a great buy, then you can lean to the sale side. Okay? So right now, that board is showing you how expensive everything is. Does that make it cheap? Well, not if you think things are going out of business or they're going to rocket back to new highs. But if you don't think that's going to happen, you think we're now going to be stuck within this up and down 15% range, then it is expensive, right? The market is basically priced options to take the middle away. All right, they've taken the middle away. What they're doing is they're making you make a bet on the ends, on the wings. Is Apple going to go back to the all-time highs, or is it going to go down to 100? That's what they're making. They're forcing you to make a bet on that. If you think you're going to win in the middle, it'll be very, very hard to do. It's going to be hard to do.
Yeah, that's so interesting. How about for people that are day trading options?
Sure. Day trading options, a little bit different mentality. You can use the same thing, right? The tool's going to work the same way, but I mean, day trading is high speed, daily. What you're essentially doing is buying deltas. What you're essentially doing, if you buy, you buy an option for $1 and, it has a 30 delta and the stock goes up $1, it's likely to move up around 30 cents in that 5 minutes or 10 minutes. However, what I would tell people, and I can talk about this for an hour, but in the morning, the market makers are sneaky. So they want to make money off the flow. What they might do is they might actually raise volatility. If there's more buyers than sellers, like for example, it's pretty easy to see if you're in the pit, standing in the pit of Apple every day, and you're a market maker, right? And you're standing in this pit, and every day at 9:30, the buyers come in. All the day traders come in, buying calls, buying puts, buying calls, buying puts, right? And then what happens at 2:30? Day traders are selling them out, selling the calls, selling the puts. I made money, I lost, whatever, selling them out. Well, if you know that, what would you do in the morning? Well, most people don't know this, but if you're a market maker, if you wanted to raise the board or raise the volatility, It's just it's like a knob. Picture it like a knob where you go, I want to raise the volatility, and you turn it up. Like the heat, you turn it up, and the prices get expensive. When after the first 15 minutes, after everybody's bought options, what do? They turn the knob down. Now, can you see the options go, the prices go down? No, it's like they turn it down, and people start wondering like, hey, I bought these for $1, it was a 30 delta, and the stock went up $1 and it only went up 10 cents. Because what they did to you was in the morning, they turned up the volatility because they knew everybody was coming. As the market moved, they lowered it down. And that's how they take money from you without anybody knowing. And guess what they do at the end of the day? So if this is flatline, this is where it's supposed to be. In the morning, they raise it because all the buyers are coming in. Guess what and then after about 10 o'clock, it's back to, like the institutions come in, and if it's too high, the institutions hit it. So they don't keep it up there too long. They move it down, and all day it's trading around here. And then at the end of the day, they can just lower it and basically move the pricing down. And when people are getting out, they're getting out here, then by the end of the day, they can close it at the flat level. So they can literally turn it however they want. Now, Apple has a lot of institutional players, so the institutions sort of keep it in line. But any other name, you know, where the market maker is simply, you know, there's only a few traders in the name, they can just up it and down, you know, push it up, push it down, and nobody even knows it's gone. Nobody even knows how it disappeared. Nobody even knows how they lost. Or what happens is you make money, you just didn't make the amount that you thought you should have made. And that was simply because somebody did this to you and then that to you, but you have no idea.
So it's less likely in your big liquid names like an Apple, or if you're trading like the SPY or the Q.
A little less likely, yes, a little less likely, because it's harder because the machines, if they push it too high, if a market maker tries to do that, the machines come in and knock it down quickly.
That's so interesting. Yeah, I didn't realize that. That's good. I would always gravitate towards the more liquid names anyway, just because like for other reasons. But I didn't know that was part of it.
Of course. Yeah, it's sneaky. There's a lot of tricks. But look, what I do in 3 Steps to Profit, which is the Options Geek educational area, is I make sure people walk away understanding risk reward and how to bring risk reward out of the options into their process. Now, let's talk about Options Geek quickly. Options Geek essentially is divided into 3 parts. It's the education, which I believe to be the best education in the world.
Now, I agree with you on that, by the way. Like, I've seen a lot of options education. Like, I've been trading for 20 years as well. The way that you explain things and break them down, like that's why I love having you on the show. Yeah,
I appreciate it. But yes, I'm telling you, it's the best. I'm not trying to oversell it either. It's the best. So the education is the best, and then the tool is awesome, and it helps people, and it gets people to really understand what's happening, okay? So that's that's 3 Steps to Profit. Free membership is also too. I give everybody, you know, what I want people to do is feel comfortable with me. So I give people a lot in the free membership just to feel comfortable, get to know whether or not they like me or not, whether my style of teaching fits their needs, and then they can jump in. But 3 Steps is the education, lifetime education, and lifetime access to the tool, okay? And then I have winning picks. So that's for one type of trader. That's for one type of person. Usually that person is the person that wants to do it themselves, right? Because I teach my process. I teach process, I teach options, and I give you the tool. Winning picks, I use my process to make these picks that I'm giving people 2 to 4 times per week. So each week I give 2 to 4 trading ideas. People get to trade them. We've done fantastic with them. And that's for people that, you know, they don't want to do the work each night to find the ideas. They don't want to, you know, look and search. They have no interest. They want the picks so that they can play the game. What I did was with winning picks, I've essentially gamified options for people. Okay, I have gamified options. I've essentially said, this is the game we're playing. Okay, I'm going to give you the picks, and you're going to do what I say. We're going to build a plan together. After you have your plan, we're going to stick to that plan, and we're going to start playing the game.
Yeah, that's great.
So that's winning picks. What I've done is I've put it all together. I packaged it all together. I give 3 steps to profit, lifetime membership, the options tool, lifetime access, and I give 1 month of winning picks because these are educational too. People actually learn a lot. A lot of people, they tell me I learned so much from your
Look at this. What I love that you're doing right here, you're showing both the wins and the losses.
Yeah, because it's a game. It's a probability game. Of course you're going to lose.
Right, and like, well, look at this. So, like, a lot of people think that, oh, like, you need to win a lot in order to make money. But no, look at this. Like,
No.
you're batting at. So, what would you say that your batting average is? Like, eyeballing it, I'd say like maybe around like 35%.
I was going to say 350, 400, 350, 400. Yeah.
Yeah. So you're already in the Hall of Fame because, like, look at these performance returns. Almost 60%, 150%. Like, Jesus Christ.
Let me tell you, in February, the average member should have been up at the low, 50%. At the high, some people could have made 250% their money.
That's fantastic.
So,
fantastic.
You know, now in March, it's proving a little challenging. We've slowed down. Like I'm giving very light trades. What I'm doing in March, to be honest, is actually giving a lot more, helping members understand. This is the lesson of a lifetime, right? We're living something that's never happened before, this up and down 10%. So I'm trying to, keep the members patient and teaching them as they go, right?
Yeah.
As we're doing this, it's like, slow down. Just because the market's moving, that doesn't mean we have to trade. We're trying to pick our spots, right? It's better that you learn what's happening here and understand what I'm trying to tell you, that it's not going to matter if volatility is high or low. Right now, the stock is either going to be, a $50 stock is either going to be 10 or it's going to be 100 again. You know, that's what it is. Win is likely not going to stay at $45. Okay, win is either going bankrupt or it's going back to 100.
This stuff is so great.
So yeah, so every trade I took is there. You get to see every trade we took. You get to see the winners there. We've had losers. You know, at the end of the day, we are trying to find a balance.
So $10,000 back in March of last year turned into $53,000, almost 54 in 9 months.
For the average person that started in March, yes.
Wow.
Hey, guys, look right out of the gate. Look right out of the gate. We had tremendous 2 months. We caught the APC takeout. We had Viacom B in there, 400%. I mean, they're all up there. They're all there. But we had the APC takeout, which was 1,700%. Some guys had 1,000%. Some guys had 1,500%. You're talking about 10 times your money on one trade. So I know guys, there are guys that have made more than this. Mm-hmm. Now, if you started in June was tough. You eked out a little bit, and so it depends on where you start, but now we haven't shown February there. February jumped up, decent amount again.
Well, regardless, these returns are fantastic. No matter where you are.
They're great. People are excited, everybody's excited. People, and look, it's what I tell people is there's a certain mindset that you need for this game. This is a game. Mm-hmm. We're not falling in love with options, meaning we're stopping ourselves out religiously, okay? You get hurt when you blow past your stops. So in options, it's just the same as stock. Stock goes down, option goes down, you have calls, you get out. We're on to the next one. And what we're simply trying to do is win 3 or 4 times out of 10. Where people, what people get frustrated is what happens if you come in, you win the first one, and then you lose 5 in a row. Okay? What I tell people is, look, judge me on 10 to 20 trades, not on 3. I don't know what's going to happen in 3 trades. They could all be right or all be wrong. I have no idea. But I know that over time, we'll do okay.
But before we jumped on the call, you had mentioned that you had some time constraints today, so I want to be sensitive to that. It's just hit 5 o'clock.
Sure. Give me some questions and answers. Give me any questions that people have.
Yeah. All right. Yeah. So everybody that's here, use the chat. If you scroll your mouse around, there'll be a little chat box. You'll see a little Q&A bubble. Type your questions in, and yeah, like Felix is good enough to stick around for a few minutes and do a little Q&A with everybody. To the coin flipping example that you were using, yeah, so if you flipped a coin 3 times and it lands on heads every time, that doesn't mean that you have a 100% chance of flipping heads.
That's right. That's right. And that, you know, the game of heads or tails is a great way to think about it. It's how do you understand that you're never going to hit heads forever. Mm-hmm. And so when you're playing the game of heads or tails, you're trying to take advantage of the payout because you know the percentage probability of winning and losing is 50-50. So that game's an easy one to know. If you're getting paid more than $1, mm-hmm. then you want to play that game, right? If you're not, then you don't want to play that game.
So here's a question. Well, where do you think that we're heading from here? Right? Like you mentioned earlier, like we've got Perfect. This 50-50 shot.
Like, great question. Great question. And my first answer is I have no idea, but this is what I tried to do. Put up a chart of the S&P 500, a bigger one so I can see it.
Okay. Yeah, this is the daily chart of the S&P.
Can you narrow it so I don't have so much of the, yeah, right, that's good. So to me, what's a big level is, what's that low in June?
Over here?
Well, that was last year, so 230, that's a big level. So, by the way, so guy calls me up yesterday, asked me yesterday, what do you think? I don't even know, where did we close today?
Today, well, where did we close? 2366.
2366, 236?
Yeah, so we undercut the lows, but we've been closing above them.
Okay, so the two, what did we close on the SPY? Tell me the SPY. That's what I look at.
All right, let's go.
I'm not good with big bet.
Yeah, on the SPY we closed at 240.
Right, sounds about right. Okay, so take a look at that chart. So right there, that low there in, what was it, October, what was that, December 2018?
Yeah.
That was 230, right around there, right? 229?
Yep.
So people asked me yesterday, like, what were my thoughts? And I said, what they will probably do, because everybody will be trying to buy 230. Everybody's going to be buying 230, leaning on that. What they will likely do is likely push it through the lows so that everybody gets stopped and then take it right through. So one of my members
to the downside or to the upside?
What's that?
Right through the, so like heading lower or higher?
So what they'll do is the market knows people are buying 230. So what I said to a guy, I said, I'm buying the 235 calls right now. He called me and I said, yeah, I'm buying the 235 calls right now. Why was I doing that? Because I said, I know they were only $1 because the market had just gotten busted through 229 and it started trading 228, 227, which is doing what? It's forcing everybody to sell out of their stock. And so the 235s were $1 and it was like a lotto ticket. It was like, I actually think it can go to 240 if we actually get through. So that guy loved it. It actually went through. He thought I was a genius. Not a genius, it just, the market is trying to kill as many people as it can. Here's what I think. March 20th expiration, which is Friday, has an enormous amount of options and open interest. And when open interest comes off, open interest acts almost a little bit like friction, right? If there's a lot of open interest, you kind of get stuck. So 240, you'll see that there's a lot of open interest. There's a lot of bets, higher and lower. Now, there's a lot of people coming out of the woodworks because why? Because if you look at April options, they're really expensive. Like, if you look at the April 240 puts, I gotta believe they're around $12, $13. I don't even know.
Yeah, let's put on
the SPY.
Oops.
Can it go up?
Well, what date are we looking? The 20th, right?
Yeah. No, April.
April. I'm sorry.
April 17. And go back, press the little blue arrow next to calls. See next to calls? Yeah, press that. All right, so now go up a little, or I'm sorry, go up in strikes.
Go.
Yeah, so we can see where we are. Keep going. Does it go any further? Yeah, all right, so we're right around here. Okay, so it's after hours, so things are a little wacky. So the 240s are $17.50. Okay,
Yeah.
the puts, where are the 240 puts? $18. Does that make anybody interested in buying them? Not really. Usually you want to be like, oh, they cost $2. I'll buy them for $2, right? So look at the open interest. The open interest there is 59,000. That's a decent amount, actually. That might have been there for a while. If you look down at the 225s, you can see the open interest is 111,000. That's, again, pretty decent amount. Now go to March 20th. Prices are going to be a lot lower. Prices are going to be a lot lower. Why? Because $4. Now that's starting to be reasonable, right? So people might take a bet on $4 because the things are moving up and down 10. So you can see a little volume there. Well, after March, if you look at March 23rd, go there, March 23rd, Monday, a lot of that open interest disappears. You're not going to see a lot of open interest there, which tells you what? Less friction. The market can finally move, right? It can go up, it can go down, it can move. Why? Because the market's going to go where there's the least resistance. So if everybody's betting on calls, the market's going to go down. If everybody's betting on puts, the market's going to go up or have a tendency to move up. In this case, the market's betting on up or down, it looks like, for tomorrow, right? Which likely means that it's not going to have that big of a move. Likely, I don't know, it may, but it likely means that it's telling you that when everybody's making bets, it's not going to allow it to happen. But on Monday, all bets are off, right? Everything expires. Now somebody has to make the decision to buy an $8, $9 put. It's not very exciting. Nobody does that. That's when the market crashes, right? That's when the market moves. So I think the band is, I mean, you saw the April numbers. It's $17.35. The market is basically saying, here's a quick back of the envelope. There's 35 times 1 1/4 is how much? 8 3/4, 44. It's about 44. So 44 up and down gets you to about 344, 296 and 384. The market's basically pricing in 296 and 384 68% of the time. Back of the envelope. I mean, how do you make money on that? Like, again, they're pricing these wings. So where do I think the market's going? I think it could, the other thing that the market doesn't do, it doesn't make it easy. So if you're like, oh my God, 35 points, I should sell the straddle. I can tell you the market's probably going to test the downside or the upside barriers to force you to make a decision on whether or not you want to stay short or not. It's not like you're going to sell $35 and sell the straddle, collect $35 and not, and, you know, be able to go to the beach and relax. I mean, the thing is the market will test those levels. So what does that mean? It can go to 280 or it can go to 290. I have a feeling, where did Boeing trade today? Show me where Boeing traded. Where did it close?
97.
97, so that's down what, $4?
This is a monthly chart. Well, let's find the daily chart. Well, from yesterday it closed at 101. Yeah, so down $3.
So down $3. Okay, so
yeah, $4.
Hang on one second. So Boeing, if you look at the January options, you don't have to look at it, I know. Boeing January 100 puts, you know how much they are? The 100 puts, the stock's trading, go to Boeing. Stock's trading 97. Go to January. $40. January 100 puts are trading $40. What is that telling you? It's like a 50-50 chance almost that it's going to go bankrupt. You see
wow,
that?
that's insane.
So it's pretty nuts. And I told you earlier at the start that if Boeing goes bankrupt, we have a lot bigger problems than anything else. And so the market is sane. The market is smart. And you got to respect when they do that. You got to respect that $40 for the 100 put, what's really going on. And that's why I tell people, look at the risk reward. Look at how they're pricing these options. This is what the market is thinking. If you see Boeing start trading down to 80, 75, the market's going to be in a lot of trouble. We can breach 300. I don't think by tomorrow, but I think by next week, you could see a move quickly towards 300 if they don't get this under control, if the news is not as, they can't keep up with this vaccine talk. They need to do, they'll need to act and do something, because if Boeing is going out of business, or MGM starts going out of business, Las Vegas Sands, or, all those companies, the airlines, and the airlines need a bailout, and everybody needs a bailout. Well, the government's going to be stuck. This is where the government's going to be stuck. They can't pay $100 for Boeing. The world would go nuts, right? Be like, how, when something like this happens, you got to take this, like if the government's going to make an intervention, they got to get the stock at the lowest possible price. So the government will have to allow the market to sort of go down, just like they did in the financial crash, and then get involved. It's like a last effort. It's like, okay, we're going to nationalize everything, but you can't really do it until things are like, Boeing is at a point, but the rest of the market has to also feel the pain.
Wow.
Fair enough?
Yeah, man. I can't wait to go back and watch the replay of all this, because you're blowing my mind too, and that's why I love your education too. You explain things so well, and you get to watch it a few times, because it's simple concepts that you teach, and you explain it well. But re-listening to it a couple of times, and I do this with all the best education that I find. I'll go back and I'll revisit it 4, 5, 6 times.
Awesome. Yeah. What I would tell people, look, first of all, I charge a pittance to what it's worth. But what I tell people, if you really want to get a sense before you make the commitment, I have a live seminar that I did. It's 3 hours long. You get your money's worth. I charge a very small amount to allow people to see and feel and hear.
Where do people get that?
What's that?
Where do people get that?
They get that once they sign up for the free membership. They will get an email. They will get an email that says the option secret. Or go down to that bottom. Instead of clicking it, go down and see where it says, if you bought an individual course, click on that. The live seminar, 2-part live seminar. Click on that. And that gives you a real overall, it gives you a good lessons, an overall look on what I do, what I teach, how they'll proceed, what they'll learn, how they'll learn it, the game we're playing. It's all in there. If you like that, then you'll say, you know what, this is for me. And I made that so cheap. It's now that everybody's at home, people should be loading up on this one.
Yeah.
But don't buy it from the site. If you become a free member, don't buy it right here. Here I charge $100. If you buy it for the site, I charge it a lot. For the free membership, I make it very, very, very affordable for everyone. It's basically done so that everybody could actually learn, could actually see it and learn, and see what good education is what option education should have been.
Yeah, and you know what? More people are reaching out to me now, because everybody's quarantined. How can I make money at home?
That's right. First they gotta learn, right? First they gotta learn a little bit.
Yeah.
Awesome. Well, listen, if there's more questions, you send me the email. You send me an email, and I will commit to answering all your questions. Is that fair?
Thanks a lot, Felix. I really appreciate that.
Awesome. Thank you for having me. I appreciate it, and I hope your members found this interesting.
Yes, thank you. Thank you, everybody, for joining us today and listening in, and for your great questions. We really appreciate it. Felix, always a pleasure, man. Thank you so much.
Take care.
You too.